Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in company filings. Today we are going to dissect the latest quarterly report from Industrial Logistics Properties Trust, or ILPT, and let's just say there are some interesting moves happening on their balance sheet. Alright, let's dive right into the numbers. Looking at their balance sheet as of the 30th of September 2025, we see that their total assets stand at over $5.2 billion. That might sound like a lot, and it is, but it is a dip from the more than $5.4 billion they had at the end of 2024. Digging a bit deeper, their real estate properties, which include land and buildings, were valued at over $5.1 billion. This is also down slightly from the previous year's figure of about $5.18 billion. Now let's talk about what they owe. Their mortgage notes payable, which is essentially their debt from loans secured by their properties, is a hefty sum. As of the 30th of September 2025, this stood at over $4.19 billion, a decrease from over $4.3 billion at the end of 2024. It looks like they've been making some headway in reducing their debt, which is generally a good sign. When we look at their income statement for the 9 months ended the 30th of September 2025, the company reported a net loss of over $91 million. That is an improvement from the net loss of over $102 million in the same period of 2024. So while they are still losing money, they are losing it at a slower pace, which is a positive trend. For the shareholders, the net loss was over $64 million for the first 9 months of 2025. This is better than the more than $71 million loss attributable to common shareholders in 2024. It is also interesting to note the number of shares. For the 9 months ending the 30th of September 2025, the weighted average common shares outstanding were about 65.9 million, a slight increase from 65.6 million in 2024. This increase could be due to issuing new shares or from stock-based compensation plans. Let's switch gears and look at some non-GAAP measures like net operating income, or NOI as it is often called. For the 9 months ended the 30th of September 2025, their NOI was over $262 million. This is up from over $257 million in the same period of 2024, showing that the actual operations of their properties are generating more income. This is a very important number for real estate companies because it focuses purely on the operational performance of the properties themselves. And now for funds from operations, or FFO, this is a key metric for real estate investment trusts. For the first 9 months of 2025, FFO attributable to common shareholders was over $34 million. That is an increase from about $26 million in 2024. This shows a healthy increase in cash flow generated from their core real estate operations when you back out things like depreciation and gains or losses on property sales. They also present normalized FFO, which adjusts for one-time items and other specific events. For the 9 months of 2025, their normalized FFO was over $44 million, also an increase from around $26 million in 2024. This rise in normalized FFO suggests that after accounting for a loss on debt extinguishment and incentive management fees, their underlying operating performance is improving. Let's look at rental income. For the first 9 months of 2025, rental income was over $334 million, a modest increase from nearly $332 million in 2024. This growth, though small, is positive. Depreciation and amortization, which is the accounting way of spreading the cost of assets over their useful lives, decreased from over $130 million in 2024 to over $123 million in 2025. This decrease is partly due to some acquired leases having fully amortized. General and administrative expenses saw a notable increase from over $22 million in 2024 to over $28 million in 2025. A big reason for this is the accrual of incentive management fees. This means they are setting aside money now for potential bonuses to their management based on performance, which hints at confidence in future profitability. A significant item this period is the loss on impairment of real estate, amounting to over $6 million. This indicates that they've had to write down the value of some of their properties, likely those that are being held for sale. This loss highlights a strategic decision to divest certain assets. Interest expense, a big concern for most real estate companies, decreased from nearly $221 million in 2024 to just over $201 million in 2025. This reduction is largely due to paying off their floating rate loan and no longer amortizing future costs related to its interest rate cap. Connected to the debt repayment, they recorded a loss on extinguishment of debt of over $5 million in 2025. This is a one-time cost associated with paying off that loan early. Looking ahead, the company has plans to sell some properties. They have 2 properties under agreements or letters of intent to sell, with an expected aggregate sales price of over $51 million. This shows a clear strategy of divesting certain assets. Tenant concentration is always a big factor for real estate portfolios. FedEx represents almost 28.3% of their annualized rental revenues, and Amazon makes up about 6.8%. These are significant tenants, meaning their financial health directly impacts ILPT. When it comes to market risks, interest rates are always a hot topic. Currently, they have floating rate debt primarily from the Mountain Floating Rate Loan, which is over $1.4 billion. Their interest rate is tied to SOFR, the secured overnight financing rate, plus a premium. They are using interest rate caps to manage some of this risk. Now, here is a crucial point. If interest rates were to go up by 1 percentage point, their annual interest expense on this loan, even with the cap, could increase significantly. The report estimates that a 1 percentage point increase in interest rates could lead to an additional annual interest expense of over $83 million, potentially impacting earnings per share by about $1.26. This is a critical factor to watch as interest rates can fluctuate. On the flip side, they have a substantial amount of fixed rate debt totaling over $2.8 billion. This means roughly 2/3 of their debt is locked in at current rates, shielding them from immediate increases in borrowing costs. However, if rates were to decrease significantly, they would not benefit from refinancing at lower rates until these fixed rate loans mature. Looking at share activity, during the 9 months of 2025, they purchased over 73,000 shares. These weren't open market buybacks, but rather shares repurchased to cover tax obligations when employees like their officers and RMR employees receive stock awards. This is a common practice and helps manage tax liabilities. Distributions to shareholders are important for REITs. For the first 9 months of 2025, they paid out over $4.6 million in regular quarterly distributions. They recently declared another distribution of about $3.3 million. This shows a commitment to returning capital to shareholders, which is expected from a REIT. There is also a lot of talk about their relationship with RMR, which is their management company. For services to their consolidated joint venture, the joint venture pays RMR directly, and this amount is then credited back to ILPT. This structure ensures they are managing costs effectively. And lastly, on the legal and compliance front, the company has provided all the necessary certifications affirming the accuracy of their financial reporting. Now, for my take on Industrial Logistics Properties Trust, the company is showing signs of recovery. They are reducing debt, their net operating income is growing, and their FFO is on the rise. The strategic sale of some properties and a focus on core operations are positive signs. However, the significant exposure to interest rate fluctuations on their floating rate debt remains a considerable risk, especially with the current economic climate. The reliance on large tenants like FedEx also poses a concentration risk. While they are steadily improving their financial health, they need to continue managing their debt carefully and diversifying both their tenant base and their properties. The company's direction seems to be towards optimizing its portfolio and improving profitability, which is a good strategy. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.